Today on Stock Charts in Focus, I come bearing gifts. I'm giving you the 29 most important charts, all packaged into one chart list straight out of my own account. You are going to leave the show today with this list in your Stock Charts account. Now, as you're going to see, we're going to go through all 29 charts. This is, I like to say, the most important list in my account. I review it every weekend. I really would not go a trading week without reviewing these 29 charts. So you're going to see it all in action and see it explained very clearly. Of course, you know what it is. It's all new. It's all here. It's Stock Charts in Focus. All right, my friends, welcome to the show, Stock Charts in Focus. Of course, our product focus show here on the channel, where we dig into the site, dive into the tools, walk you through those features, and ultimately help you get more value out of stock charts. That's our mission here every Friday. Occasionally, we even do little chart giveaways like we're doing on this week's show. So you're going to leave this one with some stuff to take with you. My name is Grayson Rose, Director of Operations here at StockCharts.com. As always, it's a pleasure to be with you. I'm excited for this episode. It's going to be a little bit different. You know, we spend a lot of time from week to week digging into the tools and talking about, if you want to do this, click this button. If you want to search for this, use this box or use this menu, things like that. On this week's show, we're getting a little bit personal. We're going to reach into my own account. We're going to talk about the most important chart list in my account. 29 charts. I review this every single Sunday. I have for many, many years. This truly is one of the most important chart lists in my account. I would not go a trading week without reviewing this. I've got my own process. We'll talk a little bit about this as we get into it. I've got my process, though, my routines that really are all kind of built around Sundays. Sundays are kind of sacred to me when it comes to the markets. That's when I sit down with my account. I go through those chart routines. I review what happened last week. I review what's happened over the last couple of months and years as well. Dive into those markets through charting. And then I take a look at, what I'm thinking is going to happen this week. I start to dive into the things that I own, look for new opportunities out there, all that good stuff. But it all starts, those Sunday routines, they all start with this chart list. Now, we're going to go through all of the 29 charts in this list one at a time. I'll explain them, explain why they're important, talk about what they are. And like we said in the open, you're actually going to get this list. So if you're a Stock Charts member, we're going to have a link down in the description below. You're going to be able to pull up this chart list, see those charts, and even install it into your own account. We'll take a look at exactly how to do that later in the show. So really is a bit of a chart giveaway this week. You can take these 29 charts, put them in your own account, and start to use them in your process. Now, before we dive in, I want to tell you kind of why I think this matters, why this is important. First off, if you're looking for a great way to kind of see everything that's out there in the markets, this chart list is really going to help you. It's a great one to kind of ground you in some crucial charts that you're going to want to take a look at from week to week. You'll see exactly why in just a minute. The other thing, though, is that this can be a great kind of starting place for you. These charts are all built, they're customized for me. They're kind of based on the way that I want to see the markets, but they can hopefully inspire you to build some of your own charts that are similar. Build your own kind of market evaluation list, as you're going to see. So you can use this list as is, or use it as a starting place. Customize these charts, add your own indicators, add your own time frames, make things really work for you. There's a lot of pretty tricky, pretty advanced kind of setup things that I've done with these charts. It's a fantastic display of some of the power that you have on stock charts building these charts. So you're going to see a lot of that stuff. But again, this can be kind of a good inspiration, a great starting place for you to either take this list, use it as is, or build on it, add to it, make it your own, and learn more about all the powers that you have here at Stock Charts. So, without further ado, let's jump over to the site. We'll take a look at this list and we'll get into it. Here we go. So we're starting here on the members dashboard, and we are going to jump down to my chart list. I'm going to use this little button in the top right corner, give that a click, and that's going to scroll me down here. Now, we've actually touched on some of this on episodes of the show in the past, But what we're actually looking at here today is really kind of this whole collection of lists. You can see that I've got a number of lists that are named weekly and a number of lists that are named daily. Now, typically, I try to get through all of these daily lists every single day. There are some that are more important, so I kind of focus on those. But every single week, I make sure to review all of these weekly lists. And as you can see, the very first one in my account is that weekly market evaluation list. You can see right there, 29 charts in this thing. We're going to blast through this, and I'm going to show you exactly what's included, what these charts are. We're going to go pretty quick, so feel free to review this episode in the future, especially if you download this chart list into your own account. But this is kind of really what we're talking about is, building a process around these chart lists. Again, these are things that I review every single day and every single week, and they give me a great sense of what's happening in the markets through all cycles because I'm not skipping weeks, right? I'm looking at this same set of 29 charts every single Sunday, sometimes in the morning with a cup of coffee, sometimes Sunday night with a glass of wine. But I'm looking at the same 29 charts through all market cycles, and that consistency is what really makes this thing matter, really what makes this this chart list fly. So I'm hoping that you use this as kind of an inspiration to build a little bit of your own process. But as you can see, I've created this kind of organized chart list approach. And so when I sit down on Sundays or when I sit down in the morning to go through my chart list, see what's happening in the markets, I'm not fumbling around through all of my chart lists. I've actually kind of numbered these in a specific order, and I just kind of go bang, bang, bang right through these lists. So as I mentioned, we're going to start with that market evaluation list. This is the one that we're going to give you today. Again, link down in the description below. We're going to view this in chart list view, allows us to just kind of scroll through, but I actually like to use chart book view for this occasionally as well. That allows me to flip one chart at a time. For today's purposes though, make things a little bit faster, we're going to use the chart list view. So we got 29 charts to cover. We're going to try to really fly through this. Some of these are kind of related, and so we'll try to make things quick. Some we'll kind of pause and spend a little bit more time on, but others we'll go through pretty quick. You can always find me too if you reach out to our support team or find me on Twitter or anything like that at Grayson Rose. You can always find me, ask questions. I am here to help answer any questions of why these charts exist or how I use them, things like that. So I like to start again with that big broad view. Again, think about this as the first chart list that I look at every Sunday when I'm kind of getting a handle on where the markets are at and where they're heading. The first thing I like to start with is a classic intermarket analysis view. This is really kind of based on John Murphy's approach. What we have up here is a multi-year look at a whole bunch of asset classes. Now I've turned on the verbose legends for these sharp charts, and so you can actually read the names of these. It's not going to show you just the symbols. By the way, as we get going, if I mention any settings or things that I've done, you can always click one of these charts, open it up, and come down here on the Sharp Charts workbench, kind of review some of the settings. This is a great way, again, to learn some of the power of stock charts. So when I say the verbose legends, there's a little menu over here that lets you turn on verbose, default, minimal, or even turn those legends off. I like to use verbose because it makes these legends a little more full. You can see that instead of just having the symbol for some of these ratio charts, I've actually got the whole name of what they are. So again, as we get going here, if you're, if you install this chart list into your own account and you want to kind of use it as a way to learn more about what stock charts can do, if there's anything you see on one of these charts, spend a little bit of time reviewing the settings of the Sharp Charts workbench. It'll give you a great sense of kind of what you can do with Sharp Charts and with some of these stock charts tools. So anyways, up top, we've got a multi-year look at stocks. That is going to be the blue line. We've got bonds in the red line. We've got oil, the black line, gold in the gold line, makes sense. US dollar in the green line, also makes sense. We've got commodities in orange, and we've got Bitcoin actually on this in gray. So this gives me a sense of, which asset classes are working, which ones are lagging. We can see what's interesting here, Bitcoin has been absolutely hammered. So actually the worst performer over the last couple of years for all of these different asset classes. But from 2023 forward, Bitcoin has been an absolute monster. We can see the strength out of oil. We can see the strength out of the US dollar and commodities and gold all outperforming stocks over the last 2 years. So this is one of the first places that I like to start with this list. Then we get into some key ratios. So here we have bonds versus stocks. You can see the bond is before stocks in this case. So that's how that ratio works. So if this line is going down, that means that stocks are outperforming bonds. If this line is going up, that means that stocks are underperforming bonds, or bonds are underperforming or outperforming stocks. So we've got a couple of key ratios here, bonds versus stocks, gold versus stocks, and commodities versus stocks. So again, gives me a sense of, not just what these different asset classes are doing, but what's kind of the relative performance between some of these. Now, I am very, very focused on the equity markets. You'll see that, and specifically on the US equity markets. And so a lot of these ratios are going to be benchmarked against VTI, the total stock market, total US stock market. I want to know if things are outperforming or underperforming stocks, because that's kind of my focus. So I can quickly get a sense of that with some of these key ratios. For instance, you can see how much outperformance we've seen out of gold recently versus stocks. Gold has actually been really, really flying versus stocks on a relative basis. So first up in this list, the classic intermarket view. Then I like to step back from just the US and take a look at some different global market ETFs. I like to use the Vanguard family for these. Just kind of makes it easy, keeps it all in the same group here. But we've got VT, which is the total world. We've got the total US stock market, and then we have the total international index, which is basically everything in the entire world bunched together without the US. So this gives me a look at kind of where the US is versus some of the big groups out there in the rest of the world. So I can quickly see how those three key total market ETFs are doing. And then again, we've got some ratio charts down below. So what these tell me is the total US stock market outperforming or underperforming the total world? In this case, we can see that US has been outperforming. And we can also see the US relative to everything outside the US is the US outperforming or underperforming? Same kind of thing is going to go here. We can see these lines typically move together. Really could almost put those onto to one panel, but I do like to separate them a little bit. So again, how is the US doing relative to the rest of the world? That's what I'm answering here. Then I like to take a look at emerging markets versus developed markets. Same kind of deal. We've got developed markets in blue. We've got emerging markets in purple there. And we've got actually a couple of different emerging market looks here. We've got emerging markets as a whole group, and then we've got emerging markets without China. So that purple line actually is going to be without China, and the blue line is going to be with China. So we can see that down below here as well. Again, I'm charting those ratios. So we're looking at how are emerging markets doing relative to developed markets, and how are emerging markets doing without China relative to developed markets. So that's what I'm taking a look at here. Again, kind of digging into some of those different corners of the market. What I'm trying to ask here is what's kind of the risk profile of investors around the globe? If you see emerging markets taking off, typically that's signaling that investors around the globe are a little bit more risk on, right? We're seeing a little bit more willingness to take some risk in those kind of emerging high potential kind of markets. When we see emerging markets really start to fade, really start to weaken, that is a little bit more of a kind of a risk off signal. So that's what I'm answering with that chart. Then we go back to the US. Now we're looking at different market cap tiers. So we're starting to drill into the US markets here. As you can see here, we've got another big group of symbols. We've got the total US stock market. Then we've got mega caps in purple with the S&P 100. We've got large caps in blue with the S&P 500. The green is going to be mid caps, the S&P 400. The red is going to be small caps, the S&P 600. And we even have a micro cap ETF on there as well in orange. So this is going to allow me to see how stocks are doing at different cap levels, at different market cap levels. Are mega caps outperforming? Are small caps outperforming? What's kind of the mix in the market there? And then again, we can look at those different groups relative to the S&P 500. So that's what we're doing on this chart. We can see all of those here on a percentage basis over the last 2 years. And then down below, we've got our key ratios. So in this case, we're looking all benchmarked against the S&P 500. We're looking at how mega caps are doing relative to large caps. One quick note about this one, it is kind of a funky group because the S&P 100 is part of the S&P 500. So this one is a little bit odd, but it does still tell you, are mega caps outperforming large caps, or is the opposite true? Down below, we've got the exact same concept all against the S&P 500. So how are mid caps doing relative to large caps? How are small caps doing relative to large caps? And how are micro caps doing relative to large caps? This tells you that the big stuff is really working. As we can see, the S&P 100 has been absolutely flying. Obviously, Magnificent 7 has been a big part of that conversation. But we can see how much kind of damage on a relative basis has been done to mid caps and small caps and micro caps. So that's what I'm answering on this chart. Then we get into some other flavors of the market. We can spin the market by market cap. We can also spin the market by kind of factor, growth versus value versus income, dividend yielders. So that's what we're looking at here. Again, we've got growth in green, kind of makes sense. We've got value in red, and we've got dividend payers, income yielders in blue. So we're looking at those couple of different factors, and then again, relative to the S&P 500 itself. So we do have the S&P 500 there. That is going to be that black line. So then we can look at some key ratios. In this case, now instead of looking at these different factors versus the S&P 500 itself, we're actually pitting some of these kind of factors against each other. One of the classic things that we hear a lot about, right, is growth versus value. Is growth leading? Is value leading? What's kind of the mix in the market there? What's the flavor? Again, all intended to kind of address, what's the risk profile of investors and traders right now? Are investors and traders really more risk on or really more risk off? With these ratios down below, we're taking those different cap tiers and we're actually asking, is growth outperforming value or vice versa at the different cap tiers? So if we look here, we've got S&P 500 growth versus S&P 500 value. If this line is going up, it actually means that growth is outperforming. The story in 2022, right, was that value was absolutely crushing growth. Growth stocks were getting absolutely slammed. We've actually seen that reverse almost to the day in the start of 2023 and beyond. We can see how aggressively that ratio actually reversed. We've seen that not just at the mega cap level or the big cap level, large caps, but also in mid caps and small caps as well. So these charts allow me to see growth versus value at different cap tiers. So S&P 500 growth versus value, S&P 400 mid cap growth versus value, and then small cap growth versus value there. Especially when it comes to small caps, we've seen quite the reversal there with growth starting to outperform value at that small cap level. So it's been an interesting market this year, that is for sure. Some wacky things have been happening. So then we get into some of the more traditional charts. I like to look at some of the key indexes, again, kind of breaking things down typically by market cap, as you're going to see. But I like to just take a simple look at trend. What's the trend of the market? I don't want to ask too many things. I don't want to have too many indicators on this chart. I just want to ask, sort of gut reaction, where are these different indexes going? Are we going up? Are we going down? Are we going sideways? What's the trend of these things? So I've got a couple of charts here all labeled trend. First off, we look at the average stock. This is the value line arithmetic index. This is measuring what the average stock out there in the market is doing. If you're not familiar with this index, it is a very, very fascinating index. There's also a median stock, which I actually don't have in this list. I personally like to focus on the arithmetic, the average stock, a little bit more. But this is a fantastic index, and again, answers what is the average stock doing right now. As we can see, over the last 2 years, the average stock is just going sideways. It's below its 200-day moving average. That's the green line. The 50-day is below the 200-day. That's not a great look. But at the same time, we've really just been going sideways. So this actually doesn't concern me too much until we start to break down below some of these levels. Now we are kind of testing, obviously, the bottom of that range. We're getting pretty close to it. But, it's been going sideways. Ultimately, if you kind of draw that big box on this chart, anything, bouncing around in that box, is it really that bad to be bouncing around in that box? It's bad when we start to break below it. It's good when we start to break above it. But until we get out of that range, we're just stuck in some range-bound trading. So that's what the average stock has been doing over the last 2 years. That's what this chart tells me. Then we apply that exact same thing to a couple of other indexes. So here, again, I'm bringing back VTI. That's one of my favorite indexes to follow. That's kind of typically what I benchmark things against on a relative basis. So we're looking at trend on the total market. Again, is the total market going up? Is it going down? Is it going sideways? This is a market cap weighted index. So it's actually going to track pretty heavily with the S&P 500, as you'll see. But theoretically, it does bring in quite a lot more because it is measuring the entire U.S. market. That's what that Vanguard Total Index does. Great fund, great index to follow if you are tracking the market. So again, here we've got to look at VTI. We can see that it is going up, starting to go up. Obviously, 2023 hasn't been a terribly bad year, but we're coming back down to test sort of the top of that range that we saw really through the back half of 2022 and into 2023. So obviously a key chart to watch, but this is what I'm doing here with this is addressing, you know, what's the trend of the total market? Are we going up? Are we going down? Are we going sideways? I'd say at this point we're going up, but we're still really going sideways because if we draw that horizontal line across, we really haven't gone anywhere in 2 years. So key things that you can address with those charts here. We do the exact same thing for the S&P 500, and then we do the same thing for the S&P 400. Again, a lot more sideways trading over the last couple of years. And then we do the same with the S&P 600. So now we're looking at small caps. I personally also like to focus on the S&P indexes. That's one thing that you might notice. For whatever reason, I like the way that S&P spins their indexes. All of those companies that are in there typically are profitable as well, which is kind of something that I like to keep in my back pocket when I'm thinking about these things. So I like to keep things in the Vanguard family or in the S&P family, whatever you want to do there. But you'll see I use the S&P 600 and the S&P 400 quite a lot for mid caps and small caps. So we're doing the exact same thing, looking at trend on those small caps. And again, a lot of sideways trading. We are right at the bottom of that range though. Good time to bounce potentially. So we'll see what happens here in the next couple of weeks and months. But again, a collection of trend charts there. We're on to number 10. This is going to be a look at breadth. So now we're looking at basically participation across some key indexes. The chart up at the top is a little bit tricky to explain, but it's basically a rolling 10-day average of new highs minus new lows on the NYSE, on the New York Stock Exchange. So I'm looking primarily at this sort of purple and gray space. Basically, if you're in the purple, things are pretty good. If you're in the gray, things are pretty bad. Overlaid on that, we also have the S&P or the NYSE itself. So that's what that chart is. A little bit cluttered, but you know, once you've been looking at this every week for many years, it starts to make a lot of sense. So this is basically looking at breadth on the NYSE. Then we can dive into some of those other breadth numbers. We like to think typically about breadth as, you know, percentage of stocks above key moving averages. So what percentage of NYSE stocks are above their 200-day moving average, kind of a classic long-term view, and what percentage of stocks in the NYSE are above their 50-day moving average, kind of a classic intermediate view. So we can answer that for a couple of key indexes here. As we can see, and this chart actually goes back quite a ways. This is more of a 5-year chart. So we can see percentage of stocks in the NYSE above their 200-day moving average, pretty low at the moment, only about 25%. So most stocks out there in the NYSE are below their 200-day moving average. NYSE percentage of stocks above their 50-day moving average, even weaker, only about 15%. Now, what's interesting, though, is that you can see, because this is a 5-year look, you can see that we typically don't get that much lower than this. We are in some pretty bearish territory here when it comes to these breadth numbers. So typically, that can actually become a little bit bullish. People start to look for a bounce when you see breadth numbers this week. Now, I've also done, again, some tricky things on some of these charts. So one thing I've done for each of these panels, I've drawn horizontal lines. I've got gray lines at 75, I've got gray lines at 25, and I've got a black line at the neutral point, 50%, 50-50, right? These indicators or indexes oscillate between 0 and 100. You can't have more than 100% of stocks above their 200-day moving average. You can't have less than 0. So I've kind of put those ranges on these indexes. So we're doing the same thing here for the NYSE. Then we do it for the S&P 500. Again, percentage of stocks above their 250-day moving averages. We can see even weaker numbers here on the S&P 500. Just not a lot of stuff is working right now, which again can actually flip to become pretty bullish. We get down into some of these ranges with 11% of S&P 500 stocks above their 50-day moving average. That is pretty dang low, and we typically don't stay there for very long. So that's something that a lot of technicians are looking at right now, something that you can address with these breadth charts. NASDAQ, we do the exact same thing, 250-day. We don't look much better on the NASDAQ. We don't have a lot of stuff working there either. Then we get into advancers and decliners on the NYSE. So this is an advanced decline line there. We actually have another chart of this later on. So it looks, moving sideways there. Not the greatest look on the advancers decliners line. Then we get into new highs minus new lows, and same kind of concept. We do this across a couple of indexes on these charts. So we start here with the NYSE itself. We've got, again, measuring stocks making new highs minus stocks making new lows. If that number is going up, if this chart is in the black, if we're above zero, that means we've got more stocks making new highs than making new lows. That's bullish. That's the kind of thing we want to see if the market is going to continue to move higher. When this thing gets into the red, as it has been for quite a while now, you can tell exactly how kind of weak things have been. When you see most stocks making new lows and nothing out there making new highs, that is pretty ugly. That is pretty bearish. So this gives me a sense of, again, participation. What are the stocks out there doing? It's one thing to look at just the index level, but we want to kind of dig into the actual individual stocks within. These charts allow us to do that. So we look at new highs minus new lows here on the NYSE, then on the NASDAQ, then on the S&P 500 SPX, then on the S&P 400, that mid-cap index, and then on the S&P 600, that small-cap index. In this case, we can see that things are continuing to get pretty ugly. We don't have a lot of stocks making new highs. We have a lot of stocks making new lows. What's interesting to see is that small caps are pretty ugly. Mid caps actually don't look terrible considering what everything else looks like. S&P 500, pretty similar to mid caps there. NASDAQ continues to get worse. That is not a great look, and the NYSE has really been hit as well. So again, you can kind of dig into some of these different indexes and think about participation across those different indexes. Here's another way that I like to look at that as well. So this is, again, advancers and decliners on the NYSE, and we're going to do the same thing for the NASDAQ in just a minute. Every single day, we can measure the number of stocks in the NYSE moving higher and the number of stocks in the NYSE moving lower. There's also an in-between here, which is didn't change at all. I don't have that on this chart, but basically you add this one, and then the difference, when you subtract it from 100, that is going to be the number that didn't change at all. But from day to day, right, we want to think about, what's the participation in this move? If you see the NYSE moving higher, but it's really just a couple of big stocks that have made big moves higher, and you don't actually see a lot of participation in that move up, that tells you something. If you see the markets get crushed, but there's actually not a lot of participation to the downside, that also tells you something. So these charts allow you to answer that. This is telling you the number of stocks or percentage of stocks in the NYSE basically moving up or moving down on any given day. As you can see, obviously the last couple of weeks have been pretty ugly. So we've had a lot of declining issues there on the NYSE, not a ton of big up days. I've also done some trickery here. I've put that orange line at 75 again. Those are some of the sort of super bullish or super bearish levels. Actually, I've also got one at 90, which is very bearish or very bullish. In this case, we actually haven't seen any 90% up days on the NYSE in quite a while. So you can't even see that line right now. But again, these oscillate between 0 and 1. So it tells me about advancers versus decliners on the NYSE. And then this is basically just an advanced decline line on that index as well. Then we do the same thing for the NASDAQ. So we can look at basically participation in the move on the NASDAQ. Are stocks advancing? Are stocks declining? What do we got on that index as well? We look at the VIX next. That's my 14th chart in this list. Classic look. I like to draw that horizontal line at 20. That's kind of the key level for me, right? If the VIX is below 20, it's relatively low. If the VIX is above 20, as we have finally gotten, it starts to get pretty choppy, pretty volatile. That tells us something about the market. And then down below, I put the S&P 500 itself for a little bit of context, so I can kind of look back through history and see how specific moves in the VIX track with moves in the S&P 500 itself. Offense versus defense. Again, trying to get into the risk profile of the market, see what's happening. So this is a couple of key ratios. We've got consumer discretionary, offensive, versus consumer staples, defensive. If this line is moving up, it means that the market is favoring offense. If this line is moving down, it means that traders and investors out there are kind of favoring more of a defensive positioning in the markets. So this line has been moving up, starting to turn around a little bit, has been moving lower in the last couple of weeks, but really for the last couple of months has really just been moving sideways. Overall, though, in 2023, offense has been in favor. We've seen consumer discretionary pretty heavily outperform consumer staples. And we can do that also on an equal weight basis. So one of the things that people knock about the XLY-XLP ratio is, hey, that's a market cap weighted index or set of two indexes. And so you're really just looking at some big stocks versus some other big stocks. Well, we can do the same thing on an equal weight basis where we take that market cap factor out of this ratio. In this case, we're looking at consumer discretionary versus staples on an equal weight basis, and we can still see that in 2023, consumer discretionary has been the place to be over staples, so signaling more of that offensive positioning. I like to look at two other key ratios, technology versus utilities. Again, another indicator of kind of offense versus defense. In this case, we've seen a reversal here. We saw 2022 technology get absolutely slammed relative to utilities. In 2023, though, we've seen technology heavily outperform utilities. So it tells me a little bit more of an offensive positioning there. And then this is kind of an odd one. Within healthcare, healthcare is obviously that kind of odd sector that has some offensive, some defensive sort of split within. So what I actually like to do is take one of the more offensive corners of the healthcare sector and look at how that's doing relative to the healthcare sector. In this case, we're looking at biotech, a little bit more of a risk-on, aggressive type of industry group. I like to look at that relative to XLV, the healthcare sector. In this case, we can see that XLV has heavily outperformed XBI in this case. So healthcare overall has heavily outperformed biotech over the last couple of years. That is pretty defensive. That is not very offensive, not very risk on. And we're seeing that ratio continue to move lower. So a couple of key ratios that I like to follow there. We do the same kind of thing with leading industries next up, number 16 in this list. So we look at a couple of key indexes, key industries that are kind of, again, more offensive, but kind of lead the market. If we're going to see the market start to take off to the upside, we need to see these industry groups take off to the upside as well. It's tough for the market to make new highs without these groups following or actually leading. So we start with semiconductors, obviously a big topic of conversation in the last couple of years. If semiconductors are working, Dave Keller, for instance, likes to say you just sort of feel good about the markets. So semiconductors are one of those leading industries that I follow. Home builders up next. Again, if home builders are working, that tells you something about the market. Transportation is up next. This one has been was trying to lead, but in the last couple of months has really gotten hit and has been just very, very sideways for the last couple of years. And then retail as well. If we're seeing retail stocks really doing well, that retail industry group really doing well, that's pretty offensive. That's pretty risk on. We have not seen that for the last couple of years. We've seen retail really drift sideways. So it tells you something about the market. So a couple of leading industries that I like to keep an eye on. Then I dive into what I call my positioning and exposure chart. So a little bit of a funky one here. We're combining a couple of key things. Up top, we've got the equity only put call ratio. So how are traders positioning themselves in the market? Are traders really, really bullish, or are traders really, really bearish? This is measuring options activity basically on stocks, puts versus calls on stocks. When this gets above the red, that's very, very bearish. When this gets below the green, that's very, very bullish, but almost to the point where we call that kind of the complacency zone, where traders are just buying calls, buying calls, buying calls. They're not really thinking that the market's ever going to go down. So we like to actually kind of sit in the middle of this range. Now, what we saw here in the end of 2022 was that ratio went absolutely nuts. All these traders were just shorting the heck out of everything. So we saw that equity put call ratio really, really skyrocket there. Now we're kind of back into that neutral zone, but we have had a lot more short activity, kind of outweighing call activity over the last couple of months, kind of late in the summer and into the fall here. So a ratio that I like to keep an eye on, and I like to benchmark that or sort of compare that, think about that against what professional investors are doing. So this is the North American Asset North American Asset Investment Managers Exposure Index. Basically tells you what North American Active Investment Managers Exposure Index. That's a mouthful. This is telling you what active investment managers are doing out there in the market, how they're positioning. So it's a weekly survey of a huge group of active investment managers, professional money managers, and it's basically saying, you know, what are you doing? What's your exposure right now? Long side, short side, how are you positioned out there in the market? So I like to compare how traders are positioning versus how active investment managers, you know, big money, smart money kind of thing, institutional dollars, how are those positioned? We actually saw active investment managers really spike up with some long exposure. Now coming off of pretty bad numbers, but still a big spike up a couple of weeks ago. But we've seen that really drop back down. Active investment managers are getting pretty scared. Again, that can sort of turn bullish at some point though, because we don't typically see exposure this low very often, and certainly doesn't last. Down below that, we have a crazy chart. Again, this is really one to study if you want to see some of the crazy things that you can do with stock charts. This is the RIDEX asset ratio. So kind of a similar thing, builds off of that, but basically our money managers positioned in with more bearish exposure and money market exposure, or more bullish asset exposure. So if we see this thing really drop like we did at the end of 2022, that basically means that active managers, institutional managers have a lot of short positions out there, or they have a lot in cash sitting in money markets. If we see this thing go up, that means that active managers are actually adding a more bullish position, more long exposure out there in their portfolio. So I like to track these kind of things together. Again, it tells me what's the kind of flavor of the market right now. How are people positioning themselves out there across a couple of different groups? Then we get into sentiment. This is the AA survey, bulls versus bears. So if this is in the red, that's telling you that overall individual investors are feeling more bearish right now. We did see this finally get back up into to the bullish territory a little while ago, but has dipped back down. So individual investors, according to that AA survey, are quite bearish right now. So I like to look at that on a weekly basis. Then I get into the McClellan oscillators. Again, kind of a look at participation advancers versus decliners. I've set this chart up with the oscillator, the McClellan oscillator up on the top, and then the McClellan Summation Index down below, kind of a longer term look, longer term spin on the oscillator. In the middle, I've got the NYSE. So I like to take a look at these. Again, they kind of relate to some of those advancer decliner charts that I saw that I shared with you up above. But I like to take a look at how Tom McClellan's indicators are doing as well from a participation standpoint. How are we positioned? Then one that you might not have heard of, this is the Baltic Dry Index. This is considered kind of a leading index, basically measures the cost of specific dry materials being shipped. That's kind of a really quick elevator pitch on what that index is. But the key reason that I look at this, it's typically considered a leading index. So if you see this thing start to fall off a cliff, that can actually kind of indicate, ooh, people start to get scared. Market might turn around here. We actually saw that in 2021, right? The Baltic Dry Index absolutely fell off a cliff, and as you can see, it preceded the drop that we saw in the market. What's interesting now is that we've seen the Baltic Dry Index start to tick up. We're seeing that actually reverse a little bit, but just another index that I like to keep a quick eye on every week. Again, think of how is this moving relative to stocks, because people like to pair those together. Say that the moves in the Baltic Dry Index typically lead the moves in the stock market, U.S. stock market. Then we look at earnings on the S&P 500. So this chart up above is showing you some kind of key PE values, kind of where we would be if we were overvalued, fair valued, or undervalued. So right now we can see that kind of historically, if you think that 20 is an overvalued level, PE level on the S&P 500, we're sitting quite above that. We did sort of dip below that level, but based on earnings in the S&P 500, what would be kind of a reasonable level for us to be at? Right now we are overvalued. We have been for quite a long time though. I mean, it's amazing how overvalued this number can get, the S&P 500 value can get. Just gives me a sense of kind of where we are relative to historic PEs, things like that. Then we look at the S&P 500 PE itself. So right now, 22.75. That's the PE ratio on the S&P 500, according to GAAP earnings. And then we can also track moves in S&P 500 earnings overall. So are earnings for S&P 500 companies going up? Are they going down? Are they going sideways? Right now, we can kind of see, I would still say sideways, but they have been ticking up in 2023 after dropping in 2022. So I like to follow earnings a little bit. Just gives me a sense of kind of, directionally where are earnings going. This is a slow moving chart. Obviously, some weeks this doesn't change at all. Other weeks it does. Right when we're in the middle of earnings season, this thing becomes really important, but definitely one that I don't want to miss from week to week. Then I like to dive into rates. Obviously, this has been a very crucial chart for the last couple of years now with everything that the Fed has been doing. But this gives me a really interesting look at rates. So here, down in the black line, we have the Fed funds rate. Then we also have 2, 10, and 30-year yields. That is red, orange, and green. So we can see where all those rates are. And then in blue, we actually have the S&P 500 yield. So this becomes an interesting chart. I mean, right now you can see the S&P 500 yielding, dividend yielding, nowhere near what you're getting paid for money markets and other things, treasury bonds and everything, obviously. But at other times, the S&P 500 is actually yielding quite a lot more. So again, a long-term chart. This thing goes back all the way to 2003 at the moment. This is a 20-year chart. So long-term look at where rates have gone. But this gives you a sense of how wild the spike in rates has been. So that story, obviously, very important. Then I like to look at the yield curve. A lot of talk about the yield curve inverting and then now starting to get close to uninverting. Depends on how you spin it, but I like to compare the 10 and the 2, and we can see that that is about to uninvert, potentially going to uninvert here very soon. Down below there, obviously the S&P 500 itself as well. Then I do get into a couple of key sort of macro numbers, macro metrics, I like to call them. So unemployment rate, we've seen that tick up just a little bit, but this is a long-term look at the U.S. unemployment rate, something you can chart on StockCharts here. So you can grab that chart there. And again, overlaid on that, I have the S&P 500 itself for a little bit of context. I do the same thing with industrial production. That's another one that I like to follow. Again, a long-term chart of industrial production. This one doesn't change from week to week. It's a monthly index, but I do like to follow that from week to week. And then I do the exact same thing with housing starts. So these three charts look pretty similar. So a couple of different kind of macro numbers that I just want to keep an eye on. If housing starts are going up, that's probably a good thing. If industrial production is going up, that's also probably a good thing. If employment is staying low, unemployment is staying low, that's a good thing as well. We don't want to see those 2020 spikes like we had up to 14.8%. Crazy things. So I'd like to keep a little bit of a long-term eye on some of those key numbers. And then, of course, US dollar, got to have a chart for that. So this is, again, a long-term look, 20-year look at the U.S. dollar. We can see, the strength in that in the dollar that we've seen the last couple of years. Now, what's interesting, I do like to keep an eye on kind of these key levels that we've bounced around. I'm using the auto support and resistance tool on this. These are actually annotations, those horizontal lines. But we can see the move in the U.S. dollar, something, again, that I want to keep an eye on from week to week. So an important one for me. Number 27, we've got oil and gas. I like to keep an eye on a couple of different kind of oil and gas numbers. So here we have two. We've got Crude and Brent, West Texas International and Brent. So I like to keep an eye on what oil and gas prices are right now, sitting in the 80s on both of those. And then down below, I also like to keep an eye on nat gas prices. So we can see we are historically relatively low, 3.5 basically, but moving higher. So another one that I like to keep an eye on from week to week. Finally, this is 28. This is the, well, it says 28, but the first chart in this thing is 0. So actually, this is chart number 29. This is what I call my super core long term. So this is just a set of indexes that I like to follow, set of ETFs that I like to follow. I do own, I believe, most of these, if not all of these, so for the sake of full disclosure, but these are my ultra long-term positions. These are the things that I really don't sell. These are, my 20, 30, 40-year kind of funds. This is, my retirement style stuff. But I like to keep an eye on how these are doing. They track the U.S. market across some different sort of corners. Up top, we have VTI and SPTM. That's the S&P 1500, the 500, the 400, and 600 added together. So kind of a total market look over the last couple of years, the last 5 years, what have those done? We can see that both are up about 62 to 67%, both of those indexes. And then I've got some other kind of more specific targeted sort of factor, if you want to say that, ETFs that I also follow, and we can see the 5-year rolling performance of all of those here as well. So what I'm typically doing from week to week is kind of comparing, how are these kind of more aggressive funds doing relative to the total market stuff? Are they outperforming? Are they underperforming? What's the mix there? So you've got growthy stuff in here like IWY and IWF. You've got some stuff like SLYG. That's actually small cap S&P 600 growth. That has been the weakest of these. And then we've got some other stuff like Moat. That is companies that have a big moat according to Morningstar. Revenue, S&P 400 and 600 revenue ETFs in here, RWK and RWJ. I like to follow those. And then we've got mid-cap growth in here as well. So a couple of funds that I like to follow. So that is it for this week. Again, you get all of these charts. You can put this chart list directly into your own account. We'll take a look at that right now. Here is the page that you can use to actually install this into your own account. So we've set this page up so that you can see all of these charts. Depending on your service level, you might be restricted from reviewing certain parts of this. Again, there is a lot of kind of stock charts trickery in some of these charts. There's a lot of kind of complexity to them. So some things might be restricted to a pro account. But if you're on a pro account or an extra account, you should be able to see most of this. And again, you can save it to your own account. So all you have to do is hit this big green button right up at the top. You can see that you've got a couple of different options. I'd recommend saving that to a new chart list. And again, say include chart styles, leave that on. That'll make sure that all the settings come across. You could merge this with another list if you want. But again, I would recommend just kind of creating a new list with this in your own account. You can start to review that. You can start to modify those charts, make it your own. Bring this kind of process, bring this concept into your own approach to the markets. Again, I find that the power of this is reviewing these charts every week. Some of them don't change that much from week to week. But again, it's that consistent lens from week to week, month to month over many, many years. I've been looking at this list and it really hasn't changed that much. I've been looking at this list for many, many years. And that consistency, that consistent lens, consistent perspective through all market cycles, up and down, that's what makes this thing so important. So take that with you, put this into your own account. Hopefully you have some fun reviewing these charts, bringing it into your own process, but also making it your own, manipulating some of these. So I want to thank you for joining me on the show today. Ended up being kind of a long one. We had a lot of charts to get through there. 29 charts that I absolutely cannot live without. I review these every single week. And hopefully you now will too, because you got them in your own account. Again, I want to thank you for being a part of today's show. Remember, we do this every Friday, Stock Charts in Focus, digging into the tools, digging into different corners of the site, talking about how to get more value out of stock charts. So always something going on here. Sometimes we even give you charts like on this week. Remember, we're going to have that link down in the description below. So take a look at that. You can get these charts installed right into your own account. Don't miss that. I will see you next week for another edition of Stock Charts in Focus. We'll be back with another show. Again, my name is Grayson Rose, Director of Operations here at StockCharts.com. It's always a thrill to be with you. I'll see you again soon for another one. But until then, chart on, my friends.